Welcome back, everyone. I am Cass Piancey. I'm joined, as usual, by my partner in crime, Mr. Bennett Tomlin. How are you today?
Okay, I guess. It's another day in crypto where everything's falling to pieces.
It just keeps coming. It just keeps coming. It doesn't stop.
I miss sleep.
We're going to ignore all the noise that's been going on today. We're recording on Thursday, January 12th. We're going to focus ourselves on something that we have been really getting into, which is Silvergate, all these banks, Signature, Silvergate, Metropolitan, they're all struggling. These are cryptocurrency related banks. These guys have really been involved with the cryptocurrency industry in general. That's a lot of their customers. We previously have discussed how like Signature was selling all of their customer deposits, their cryptocurrency customer deposits, which is not something you generally see banks do. Why don't you kick us off, Bennett? I'd love to hear your takes on some of this stuff.
Sure. I think one of the most interesting things to start with is like how Silvergate and Signature kind of function. They each had their own kind of version of this. Silvergate had one called Silvergate Exchange Network, and Signature had one called Signet. And what this was a way for exchanges to effectively, by banking at Silvergate or Signature, be able to send funds to any other exchange quickly. Rather than waiting for the normal process, it could be done effectively instantaneously between any of these exchanges. And so as more and more exchanges and crypto companies signed up for these networks, you start to see a little bit of this network effect, kind of like we saw at the beginning of Tether, where each new one that integrated made it more appealing for others to integrate because you could take advantage of the existing network. And so because of these networks, or at least driven in part by these networks, we saw both of these banks, Silvergate and Signature, build up billions of dollars in deposits. And now both of them have lost billions of dollars in deposits. $8.1 billion was withdrawn from Silvergate post FTX. Signature ended up selling $8 to $10 billion in customer deposits. Both of them have needed to look to alternative sources of funding in order to sustain themselves. We'll get into that more in a minute, I think. And the other thing that I think is interesting is Silvergate, it turned out, was banking FTX through an Alameda research entity called North Dimension Incorporated. And Signature is banking Binance, or was banking Binance at least, through an entity called Key Vision Development Limited. And so structurally, there's so many similarities between these two banks, from the networks they were using, from the amount of deposits they've lost over the last couple of months, to the performance of their stock prices, to everything else they've had to do that I think, looking at these two right now in this moment, you're really seeing how this exposure to the crypto ecosystem has hurt these banks.
It's really funny because we've previously, I think a lot of people just kind of presumed that there was no exposure to the real world financial ecosystem, which was a mistake. I mean, I've been talking about how this could sneak its way into the real world repeatedly for a while now. And even you, I think, have often disagreed with me and thought no, there's no way, it's cut off. I've been saying this for a while, that this is absolutely now a part of the traditional financial system. And if you want to have an idea of exactly how, Signature is the perfect example now. Because what we had was essentially a bank run. We had a real life bank run on a real life bank. If we look at their ticker, so today, of the day of recording, they are up 13% from the previous day. They're trading at 13.75. That sounds great. Let's keep in mind, however, that they traded at one time for almost $220 a share. So that is a massive fall from grace, for sure. But it's not just about their stock price going down. It's not just about this bank run. It's about how they tried to cover up their bank run, which I'd never heard of this. Most people I know had not heard of this. It's a really interesting and strange governmental agency. It's called the Federal Home Loan Banks System. It's 11 government-sponsored banks that, quote, provide liquidity to the members of financial institutions to support housing, finance, and community investment. I'm stuck on those 2 points, by the way. Since I found out that the Federal Home Loan Banks gave Silvergate $4.3 billion. They're called advances. They're loans that people like you and I cannot get because they're at better rates than you and I could ever get, even if we had perfect credit. They're going on international markets and getting the best rates they can possibly get. But these guys, there's 11 banks. One of them is in San Francisco. Silvergate went over to the FHL Bank of San Francisco and said, please, we need a $4.3 billion advance because essentially it looks like we're getting a bank run here. And the FHL Bank of San Francisco gave them this $4.3 billion advance. When I looked at the 10K, because all of these banks are actually registered with the Securities and Exchange Commission, the whole concept is kind of weird. When I let me backtrack here.
Get into the
There's
concept.
11 of these banks throughout the there's 11 of these banks throughout the country. They work as a cooperative, and they were established in the wake of the Great Depression to kind of ensure that people were able to still get loans to get a home, to build a city hall, to whatever it may be for their community. The designation of these banks was supposed to be, okay, we're going to help them do that. Now, at some point, things definitely got out of control because by the 1980s, when we were in the midst of what was called the savings and loans crisis, the S&L crisis, it was clear that the FHL banks had experienced some sort of regulatory capture because they were torn apart. There was a bank board that was ended. They stopped the bank board. There was no more bank board after this. And instead, two different entities took over, one being the Office of Thrift Supervision and the other being the Federal Housing Finance Board. Ultimately, we had another issue with regulatory capture because the Office of Thrift Supervision was merged, and the FHFA, the Federal Housing Finance Agency, took over in regulating these banks. It seems like now that definitely didn't work because, well, maybe you want to talk about this. Somebody who is a chair, I don't know if it's for the San Francisco branch or if it's for the entire cooperative of banks here, but somebody was involved with FTX US and works for these banks. Now, who knows whether that means they recused themselves, if they weren't a part of this loan process. I mean, I hope so, but it's a weird coincidence, I guess.
Yeah, I remember seeing that yesterday and certainly finding it unusual that it was one of the board members for FTX US was also like a board member at one of these banks.
A vice chairman of one of these banks. So he was a chairman of the board at FTX US and a vice chair for either San Francisco or just the whole thing. And either way, that just is it's just a really bad look that one of the main banks for FTX would instantly go to this thing that nobody has really heard of or understands much about to receive a 4.3, let's call it a loan, because that's what it is. It's not an advance. They get a $4.3 billion loan from this governmental agency that hardly any of us are aware of, and definitely not for home purposes, not for community building. So I'm confused. What is the purpose here?
So wait.
I mean, I'm glad it stumped you, to be quite honest. But I'm glad it stumped you because it doesn't make any sense.
And several parts of this mechanism are weird. Like when I was doing not super extensive research in this, but when you first sent it to me and I started reading it, several parts were weird, like how you have to buy stock in the cooperative in order to gain access to the credit. Like if I saw that mechanism in an algorithmic stablecoin, I would go, oh, that looks fragile. That looks like the part of this thing that's going to break. My understanding was the way they contribute to homes and things like that was because they are effectively creating, or they're buying up a bunch of mortgages and using those to create a line of cash flow. And then in exchange for a claim against the assets of these member banks, they're then able to advance the expected income from the mortgages, right? Isn't that like... Traditionally.
But it's not like Silvergate is doing a bunch of home loans. It's not like Silvergate is contributing to the La Jolla area significantly. You know what I mean?
Yes, and there was a post on American Banker that I think kind of still explains the way they would justify this to themselves, where they're talking about how this cooperative of these banks, effectively when they extend these advances, get a lien against the assets of the bank itself that is higher in priority than even the FDIC. And so if any of these banks are unable to pay back their loans, they're able to effectively step in and strip all these assets out of the bank before the FDIC comes in and then has to fill up the rest. And so there are people who have argued that the existence of this cooperative has effectively created this moral hazard where this group of banks is incentivized to extend more of these loans because they have such this premier position in the stack if something goes wrong with the bank.
From what I noticed, from what I saw, I only looked at San Francisco, but from what I saw, the amount of billions of dollars that they're extending to banks, it's actually for San Francisco, let's say, I think it was something during 2020, right? So the only 2 years that I saw were 2020 and 2021. They don't have 2022 out yet, but 2020 had a significant uptick in advances that they gave out, but I think that was something still in the realm of, I don't know, 25 billion, something like that. And then it came down in 2021 to like 16 billion. And I suspect that it's going to go back up for 2022 because we have a down market and all that. But either way, let's say it jumps back up to 25 billion or 35 billion, no matter what, right? Let's say it's something in that range. A $4.3 billion loan to one entity is like a significant chunk of those advances. And the way it works, by the way, so there's these 11 banks that work together. This loan is extended via the Bank of San Francisco, the Federal Home Loan Bank of San Francisco, and they are the main bank responsible for this advance. But ultimately, it's all 11 banks that have to deal with this. So if they can't recoup their losses, ultimately, all 11 of these cooperative banks have to foot that bill. Now, like you said, they say that has never, ever had to happen. They've never had to deal with this. They haven't lost money. Hard to believe, but okay. And I don't know. Like I find the whole network to be easily captured regulatorily and to be very opaque, despite the fact that we have these SEC filings and these other things, like the idea that I just need to buy some stock as a bank or a credit union to get extended in advance.
It feels strange.
I don't know. It almost sounds like money laundering. It almost sounds like I'm describing money laundering. Like I'm like confused how that could be so simple, but that's fine. Whatever. Okay, great. What do we think happens next? I think is the question for Silvergate, right? So they've been extended this massive loan from the Federal Home Loan Bank of San Francisco. Generally, you have a year or two to pay these things off. I think it's not something that they need to worry about instantly, but it's not going to last forever either. What do we think is going to happen next? Are they saved? I think this might have saved them. I'm not sure.
I mean, maybe, right? Like, hopefully we've set up our bank regulations in such a way that even this type of level of deposits being pulled out and assets being seized, because Silvergate assets have now been seized as part of the FTX bankruptcy, the bank will still be able to tap liquidity and survive the thing. That's like the point of a lot of the stress testing and the building for resiliency. And the fear would be that the continued limitations and Silvergate's diminished ability to interact in a meaningful way with billions of dollars of crypto deposits makes them a less effective business where eventually they are unable to derive enough profits or whatever to sustain them. One of the things that's still interesting to me, and I kind of hinted at this earlier when I was talking about how FTX's banking through Silvergate was done through an Alameda research entity called North Dimension Incorporated. That's strange. That feels like something that should not have happened. And so I am curious if Silvergate is going to end up getting pulled into any of the legal proceedings surrounding FTX because of that.
I do want to propose that this might be a symptom of the financial system that we live in as well, where I think a lot of people would tell you it's pretty normal for conglomerates, massive businesses, these things to have 100 subsidiaries and different subsidiaries and doing different things. And if they need to get loans via those subsidiaries as opposed to the main company, that's nothing particularly weird. But again, I think that is a symptom of the world that we live in. That's not to say that I think it's acceptable. I think it's not acceptable. I also think that they're right when they say this happens with a lot of businesses.
So I think you're probably right that there's a lot of businesses that use a lot of subsidiaries in a lot of jurisdictions. for a lot of different reasons. I think the difference in this case is that they were moving money, and there's a lot of extra regulations on like what you need to be doing if you're moving money, right? And so like the fact that they saw presumably deposits and withdrawals that look like an exchange going to what was supposed to be, well, either an electronics importer exporter or an over-the-counter trading desk, depending on what you think North Dimension Incorporated was, that Silvergate thought those flows were the same is strange. And like the fact that they were, in a sense, facilitating whatever behavior Alameda or FTX was engaged in there.
Really interesting point that you're making, because I spoke to Frances Coppola today, who we have previously had on the show. She talked to us about banking. So she is generally a good person to reach out to about this stuff. And she directed me to a bank called ABLV Bank, which I don't know if you're familiar with, Bennett, but if you are, I'm going to just explain this regardless, so that because I was not aware of them until today. So she described something called ABLV, which was a bank in Latvia that was established in 1993, essentially right after the fall of the Soviet Union, and was pretty much designed only to avoid sanctions for Russian nationals, and was continually doing it, continually ignoring sanction directions from the US Treasury, continually just disregarding everything US regulators were trying to tell them to do, right? And this cost them everything. So what ended up happening in 2018, the Treasury said, okay, we're not fucking around anymore. Enough of this bullshit. You get no US dollars. You get none. No more US dollars go into or out of your bank. And we're gonna fine anyone who does. We're gonna crucify you if you give ABLV any money. And guess what happened? They went out of business. It was that easy. And so, and I think some correspondent banks got in trouble for helping them do this, which is what we're going to be seeing, I suspect, with Silvergate and Signature and Metropolitan and Evolve and like we could name 500 of these stupid banks that have now gotten involved in cryptocurrency. But I do think we're not going to see prison time. We're not going to see any of that stuff. Some of them are going to go out of business, and some of them are going to get fined to good God hell so they know never ever to do this again. And cryptocurrency becomes untouchable for a lot of these banks. Not every bank, but a lot of banks.
On that note, I think Metropolitan is in a little bit of a different category than Silvergate and Signature because they've been reducing their crypto business and just finally announced that they had ditched their last, say, several hundred million in deposits. That's not an exact number. I don't have it written down, but it was less than $1 billion, I'm pretty sure, that they had left over this last quarter and that they were done with the business. And the precipitating event, or one of the precipitating motivations, I think, for this might be that on January 3rd, the Office of the Comptroller of Currency, the Federal Reserve, and the FDIC issued a joint statement reiterating to banks the things they need to be aware of if they're going to be engaging with the crypto space. And I think the list of things that are highlighted in this statement really kind of give you a little bit of insight into how these regulators are interpreting crypto right now. They warn of like the obvious things, like there's a risk of fraud and scams, that there are legal uncertainties related to custody and ownership. But they also say and warn these companies that some of these crypto companies who are using them are making inaccurate public statements about FDIC insurance, and that the banks who are serving them need to be aware of that. They also reiterate that like any banks that are holding assets for stablecoins need to be aware that stablecoins as a structure may be vulnerable to a run, which can lead to a huge outflow in deposits from the bank that's holding the stablecoins assets. They also then reiterate that there is a large contagion risk in the ecosystem because of how interrelated these entities are and how much is shared between these different cryptocurrency companies. And one of the things that I really want to bring attention to that they say is that they basically tell them that engaging with cryptocurrencies that are on public blockchains is not going to be appropriate. They say issuing or holding as principal crypto assets that are issued, stored, or transferred on an open, public, and/or decentralized network is highly likely to be inconsistent with safe and sound banking practices. They are telling these banks they should not be holding cryptocurrencies, and that And like they are really emphasizing that. And then they go on to specifically say the agencies have significant safety and soundness concerns with banking models that are concentrated in crypto asset related activities. That's Silvergate and Signature. They are like drawing a circle
Moonstone
around
and Evolve.
Yes, but they're like drawing a circle around the activity of these so-called cryptocurrency banks and saying, we don't think that's what you're supposed to be doing. And like the knock-on effect of this is that we're going back to like how hard it was for cryptocurrency companies to find banking in 2017. And I expect we're going to see them all come back to their same shenanigans, meaning money
I don't know
launderers.
if did we mention, I suspect we mentioned this already last time, where it's like, oh, wow, you think this is new that these banks are freaking out and running away from all of these cryptocurrency companies? No. Like 2017, that's how Bitfinex got screwed. That's how Tether got screwed. That's how all these companies started essentially having nowhere to go. And there's a chicken and egg game here that cryptocurrency advocates and critics and skeptics like us play, where it's like on one hand, they say, well, the reason they do these shenanigans with all this money is because they can't get banking. And then we, on the other hand, are saying, well, if they didn't do all these shenanigans, maybe they could get banking. So it's a bit of a cat and mouse, chicken and egg. Who knows what's the right answer here? But we have seen this before. And I do want to, while you were talking, it reminded me that we had seen in August of 2022, now 6 months ago, just crazy how time flies, that Brett Harrison, who was the president of FTX US, had written this tweet saying, we are FDIC insured. And the FDIC almost instantly came down on him and said, you are not FDIC insured. You delete that tweet right now. You make sure that everyone understands that you are not FDIC insured, and make sure that we have nothing to do with you anymore. Don't mention us. And he had to come out and apologize, and they cleared that up. But like the FDIC has never fucked around with this stuff. The FDIC they were one of the first regulators that I was very proud of what they were doing to try to the way people discuss wanting the SEC to regulate versus litigate. That is what the FDIC did. They were like, stop doing that right now. And if you keep doing it, you're going to get in big fucking trouble. Stop. And lo and behold, here we are. A lot of these guys didn't stop. And here we go. Now you're in trouble. And it's not just with the FDIC. It's with everybody. So I'm glad. On one hand, I'm glad we're seeing this now. On another hand, I'm sorry that this is happening. And it's unfortunate that it has had to come to this, I guess, is what I would say.
Yeah, absolutely. And just one of the last things I want to kind of put a note on in that like list of risks was the susceptibility of stablecoins to run. Signature, which we've been talking about a bunch in this episode, was, or at one point had a whole bunch of circles deposits there for USDC. And so that again feels like them saying, hey, we're aware of what you're doing. Here's our statement. Do you want to self-correct or do you want the other option?
Signature, which was trading at roughly 300 and let's see what that is, $370-ish. For its all-time high, is now trading at $117. So also doing significantly bad, seriously having some issues. We don't know what this means. I want to make sure everyone understands that we are not lawyers. We are not, we're not doctors. We're nothing. We're nothing. We're nobody. We're commentators. And we don't want anybody to take what we're saying to mean that they should be worried about having money on any of these platforms. That is not at all what we're saying. I'm not trying to imply that at all. I'm not trying to suggest be scared, get your money out. Like, no, I just think that these are concerns to look out for, think about, consider. And as an industry, this is something that we need to be thinking about and be concerned about.
And if you're over the FDIC insured limit, it can always be valuable to consider diversifying the places you're storing your cash.
Hopefully most people already know that, but yes, I think that's a good point to make. And I think that's a good point for us to actually end on for this episode. Quick episode about banking, which is definitely not involved with cryptocurrency at all. It's totally different ecosystem. So yeah, thanks everybody. Hit the like and subscribe button if you want to finally see Castcoin DAO we're gonna try to buy a U.S. federally chartered bank, baby. Let's do this, guys. We're gonna buy a bank. We're gonna get banking for Cascoin, and then we're gonna leave the United States of America and get raided. But that's for another time. Anyway, yep. Take care, everybody. Thank you.